Hello, and thank you for downloading another episode of Your Life Simplified. My name is Brian Leitner, and I'll be the host of this podcast. And today, we have a very exciting podcast. There's a lot of talk about what's taking place in the market right now, the volatility that we've experienced this year. And today is going to be a great episode because we have our Chief Investment Strategist and Head of Equities, Jeff Krumpelman from Mariner Wealth Advisors. And Jeff, thanks for joining us on the show today.
Thanks for having me, Brian.
So Jeff, before we jump right into the financial markets and the economy, can you maybe spend just a little bit of time articulating what your role is within the organization?
Absolutely, yeah. So I have a dual role. The title is probably longer than it needs to be, but it's Chief Investment Strategist and Head of Equities. And so I have both, my feet in the macro kind of backdrop world and also in the granular security selection and security research and portfolio management role as well. As a chief investment strategist, I author the investment strategy commentary on a monthly basis about equities, and it's my job really to look at the fundamentals, the valuation, and the technical kind of backdrop of equities in general and the various asset classes within the equity world. And at the same time, I manage a team of roughly 7 folks, and we manage internal strategies, large, mid, and mid-cap strategies in individual equities. We have about 5 different strategies that we run, each with a different risk-return profile and objective that we manage to. And I think that having that dual role actually keeps me honest in that it's one thing to go out and have an opinion and write thought pieces about what you think is going on. It's another thing to actually employ that thinking in managing money and generating results. And I think by having that accountability, it keeps me and the team that I work with pretty darn honest.
That's great, Jeff. Certainly appreciate the work you do. I know you write for the newsletter that comes out every month. And for those that are interested, if they're not reading it now, can obviously sign up on our website to receive that and start reading that and gaining your insight and so forth. So maybe now to jump into the fun stuff. We're in early September, and the returns in 2019, by and large, have been great, right? I think we're certainly up for the year in a variety of different aspects of the market. But at the same time, it's been a bit of a roller coaster ride here in 2019. Maybe even over the past 12 months, we've had a variety of different areas of volatility and fluctuation. It's enough to make investors a little crazy. And how that plays on investor psychology. And if we just sort of reflect on what the media's been putting out over the past 12 months, we've read headlines like, worst December since 1931, or, best start to the market since 1987, which was through April, only to be followed by, the worst May since 1960s. So, there's the press obviously wants to grab eyeballs. This is something that they're good at, and it's enough to make us a little bit crazy. And so, when we think about, what's taken place, certainly in August, which is probably had the most volatility, I feel like we're starting to get some sort of, you have that negative karma and fear around recession talks that we had back in December, right? Which was around that Santa Claus swoon and things of that nature. So, maybe just from a big picture perspective, how are you advising clients today? What are some of the conversations you're having as it relates to that backdrop?
Yeah, Brian, you just bring up a great point. And in the most recent newsletter, the investment strategy commentary that I just penned, we always have a quote. And the most recent quote is from Ben Graham. And the quote is, "The investor's chief problem and his worst enemy is likely himself. In the end, how your investments behave is much less important than how you behave." So I think in this head-spinning environment that you just kind of relayed, temperament and perspective is just very important, and staying focused on the data. So you're correct in that it has been head-spinning and roller coaster-like, and the wild ride continued in August. The volatility in price swings and investor psychology doesn't seem to be letting up. And after that schizophrenic but profitable first half that you just outlined, it was the best first half to a year in 22 years. July was solid. and we hit all-time highs and recouped all those losses that we had back in December around Christmas time of 2018 and moved on to higher highs. But August now is testy again. And it's the result of fears on the trade and tariff front primarily, we believe. At its nadir, the S&P 500 was down over 4% during August. Daily volatility averaged more than 1% most weeks of the month. And we experienced 3 days in the 30-day period in August in which the index dropped 2.5% or more, and we hadn't seen that in more than 8 years. And yet the market, again, in this kind of a volatile roller coaster world, rallied 2.8% in the final week of the month, paired losses to 1.8%, left us 3% below all-time highs. And with these early gains in September, we're just 1% below the highs. And, what's funny is that's not, let alone a correction, that's not even a blip. And despite that, the general feeling is that we're experiencing a correction based on the headlines suggesting that recession is imminent. So the bottom line is, in reviewing the data, we remain cautiously optimistic and actually look for additional gains in the upcoming 12 months in U.S. equities. And we do not view near-term recession, that scenario, as a base case. And recent data releases, Brian, that just came out kind of illustrate the resiliency of the economy, and that, it's moderating, yet it's still expanding. And we saw that in the ISM, the purchasing managers data for non-manufacturing companies. The payroll reports that have come out this week have been real solid. The auto data for August, just really solid. So in this kind of whirlwind world in psychology, we think our mission in the market is to keep investors from suffering from whiplash. That's really our focus right now. And it's been these rapid swings in psychology that's caused the rapid swings in stock prices over the last 9 to 12 months, despite the fact that the market is up handsomely. We're up close to 20% this year. And we've referred to this roller coaster ride in trading activity and headlines as the wash, rinse, repeat cycle. Folks are going to read about that in the investment commentary. And it's investors' anxieties about trade and Fed policy, these policies issues that are leading to sell-offs. We call that the wash cycle. And then when the ensuing positive economic and earnings data is released and appreciated by investors, we call that the rinse cycle. The market is rallying sharply to take us back to where we should have been all along and eventually to higher highs. And we've seen that time and time again through this advance. We saw it back in December when folks, like you said, were drawing parallels to 1931, and we're saying that we're going to have a calamity close to the Great Depression or something. And then when the data was released on earnings and the economy in the first 2 quarters of the year, the market rallied handsomely, and we see this in August, September, where folks are saying, oh, the yield curve's inverting, that must mean recession. And then the data's released, and it's pretty solid, shows continued expansion, and we get this rally again. And so in this environment, what to do? We think that balance in the portfolio with our clients is the key thing. We think it's just as likely that the market melts up in the near term as that we see further weakness. And to ignore the risks of policy error would be like sticking one's head in the tiger's mouth. But to ignore the solid fundamentals and the possibility that policy may make a better than feared landing, similarly could cost one gains from here. So in these internal equity strategies that I manage, we are ensuring that we have a blend of offense and defense, a blend of exposure to the cyclical economic sensitive equities, but we want to couple that with plenty of exposure to more defensive, consistent earnings growers that are less tied to the economic swings. We do not want to, in heroic fashion, be positioned in extremes to one of those views. We want to have the offense on days when the market's rallying, but we want to have the defense as a buffer on days when it's deciding to sell off and be pessimistic. So that's kind of where we're at this point in time. Balance, Brian.
Jeff, greatly appreciated, and appreciate the viewpoint of being cautiously optimistic. And so I think we got it. I mean, great explanation, appreciate it. And your focus is really staying glued to the data and the facts, to really make sure that we're not on one extreme versus another. We're not letting our emotions take control of our portfolio. So, having said that, there is still a lot of talk about this recessionary risk that's out there. And I know that you guys have this sort of recessionary watch list that you guys are constantly reviewing with your team, understanding what those signals are so you can act on data as it changes. Can you talk maybe a little bit about that?
I sure can. And we do think it's just very important. We actually call it our yoga page. Everybody ought to have, and most people do. We have some outlet. We have, whether it's yoga or it's running or it's racquetball or it's tennis or, what have you, squash. You have something that takes that blood pressure down. And so this recession scorecard that we look at is what does it for us. It gives us the calm that we need to make the decisions that we need to make. So there are about a dozen indicators on our recession scorecard. And, I'll give you just a couple here at least to give you a sense for what they are. But in the employment area, we look at jobless claims and the unemployment rate. And both of those tend to spike significantly prior to recessions. We look at credit spreads. They also tend to really widen out. We see those dislocations in the credit market prior to recession. Everyone's talking about, the ISM, the Purchasing Managers Reports. And, I think I'm at the point where my 93-year-old mother now will ask me, what's the PMI doing, Jeff? And so we look at manufacturing and service Purchasing Managers Reports. And both of those tend to go into decline prior to recession. We look at consumer sentiment. So all of these factors, it's not just yield curve. It's not just one thing. Yield curve is part of this. And yield curve, you would have to say, is cautionary at this point. But it's the plethora, the mosaic of these factors that we key on. And on this scorecard, Brian, we look at all prior periods, and green says that they look to be in expansion mode. Yellow is cautionary. Red is negative. All of these dozen factors in 07, in 01, going back into the early 90s, they were negative decidedly and flashing red prior to those recessions. Most of these are green. Several are yellow. We have none that are really red in nature. And I would even include that with regard to the yield curve. Has it inverted, hasn't inverted? We can talk about that if you want to do a follow-up. But that's probably the most negative of all these factors. But we don't base our decision on one thing. It's the mosaic.
Thanks, Jeff. I appreciate that. Thanks again for downloading this episode of Your Life Simplified, which is produced by Mariner Wealth Advisors. And at Mariner Wealth Advisors, we're here to serve as your advocate. We help people chart a course to reach their personal and financial goals so that they can have greater peace of mind that may lead to a more fulfilling life. We do this by always putting our clients first. Because as fiduciaries, we're required to provide guidance that's in the best interest of clients, not in the best interest of a company or shareholders or anyone else. So as you listen to this podcast and have questions about maybe your own financial situation, or would simply like a second opinion, or even you have an idea for a future podcast, please go ahead and email us at podcast@marinerwealthadvisors.com. If you found the information on this podcast valuable, please go ahead and share it with a friend or family member that you think might benefit from this information. And please don't forget to subscribe to this podcast so you don't miss an episode. Thanks for listening, and now back to the episode. Let me just play maybe devil's advocate with you for just a second, because I'm sure there are a lot of listeners that are out there, that are fearful. The market's done quite well over the last number of years. And I understand you don't see some of the significant recessionary types of signals that we saw maybe back in 91 or 2000 or 2007 and things of that nature. But there is a decent amount to worry about. At least that's what the financial media would lead us to believe, right? You think about how we've been in this long bull market. Maybe the earnings have peaked. Valuations are now expensive because the market has run so far. You just mentioned the yield curve and it inverting, and you keep hearing about that. And every time you turn on the nightly news, you have different trade negotiations, and there's commentary on that almost on an hourly basis. You have issues with North Korea and Iran and other countries and things of that nature. So maybe just to put a bow on this for you, I'll ask you two questions here. Can you give us some insight on maybe just a couple of these issues? And with that, with all these issues, you still maintain a fairly constructive outlook over the next 12 to 18 months. So again, I know you have the metrics that you look at, the data, but what gives you that level of comfort to feel this way right now?
Sure. I know it is sometimes a head scratcher when you see this big wall of worry, and yet you hear this cautiously optimistic kind of message. How can that be, Jeff? What's going on? Do you just have rose-colored glasses, type of thing? And the answer, Brian, it's interesting. In my 30 years of experience in this industry, the time to really worry is when there is no wall of worry. And we can think back in times where you didn't have these items, and when PEs are over 20 and people are euphoric. That's generally when there's trouble. So when you have this wall of worry, that means that folks are respectful of risk, they're skeptical, and therefore valuations reasonable, and there's runway for additional growth in the market. And the other high-level thing I'll say is going all the way back to the beginning of this recovery. I'll never forget, folks that back in 2009 that just didn't want to get reinvested in the market because the wall of worry at that time was bank stress tests, the consumer's in a cave, never to spend again. It's all about cost cutting. There's no revenue growth. And, I could, the Hindenburg omen, I could give you all kinds of wall of worry things. And that continued through 2011, Arab Spring, 2012, fiscal cliff, on and on and on and on. There's always been this wall of worry, and that's why this market has continued in steady Eddie fashion to climb the wall of worry. And I think it's a healthy thing. So that's a very high level thing. The other fact then to come back, and when you explore these individual wall of worry items, which is what we do, that's our mission, to take a look at them and see what we think about them. But then we see if it spills over into the data. And it's not until it spills over into the data and you see consumers not spending, employment rising, all those negative ultimate signs that make us negative. So let's explore a couple of the ones that are out there right now that are kind of like front and center. Yield curve would have to be one that folks just continually are reading about. And so here are our bullet point thoughts on yield curve inversion as an example. Don't get us wrong. We think it's very important to look at yield curve because it has been a nice leading indicator. But even so, it usually inverts months, on average, about 18 months in advance of recession. And, the market tends to do quite well in that lag period before you see it. On average, or the median return over those 18 months after inversion, the market over the last cycles is up 21% on average. So you have time after inversion. I would actually argue with the fact that it's inverted. I mean, today it's re-steepened, it's uninverted. And so we look at the 2 to 10 year, the 2-year Treasury versus the 10-year Treasury, and now that is in positive territory right now, that slope. So, when it has inverted, it's been inverted for a nanosecond by a milliliter. So it's been very small. So I would be cautious in calling it an inversion. The other thing that I would tell you is that in the past, when we've seen inversion, and this is the power, and I think what is the key. It's been accompanied by two things that are absent today. First, it's been accompanied by credit market stress and a widening in those spreads and dislocation in the credit markets. And that's simply absent today. The credit markets, there's plenty of liquidity, and they're quite healthy. Spreads are tight. The second thing that's happened is that inversion's occurred when the level of interest rates has been far higher and restrictive in nature. Points in time at which rates were high enough and the Fed was hiking rates to choke off credit growth and cause economic activity to slow. Right now, the Fed is pretty accommodating. So this is more of what's known as a bull market flattening, meaning that long rates are dropping faster than short rates, similar to 1998. And we think the reason that these long U.S. rates are dropping is driven more by the low international rates you see in Europe and foreign countries, and that's drawing the attention to U.S. markets, and people are buying U.S. treasuries like crazy because it's the best game in town. So that's compared to a bear market flattening where the Fed is hiking rates and you see short rates rising faster than long rates. And it's that type of bear market flattening that tends to end economic expansion. So, we're saying it's not different. I hope I'm not accused of saying it's different this time. It's the same. What we're saying is normally you see this accompanied by credit markets dislocating. That's not happening. If anything's different, Brian, I think this time it's that the quantitative or algorithmic traders are pushing the market around on faux announcements of sustained yield curve inversion that really isn't happening right now. But we'll keep a sharp eye on this because it is something to follow.
No, I know you will. And again, I appreciate the insight. And just for listeners to know, this conversation came at a request from several different listeners over the past probably 30 days and wanted to know if we could address the market. So we appreciate, Jeff, you coming on, appreciate the comments back from listeners. And if there are other listeners that would like to hear, other topics, we have no shortage of guests and topics that we can discuss. And that's really what this podcast is all about. In addition to that, just thinking about, the headline risk and, your average investor, how they're making trades based upon what's on the news and what's in the financial media. I mean, those short-term decisions can have a dramatic impact on what their long-term financial plan is. And so, for everybody listening, just to understand, you need to sit back and think about big picture, where do I want to be in the future, what my goals are, and how do I accomplish those goals? And then, of course, trying to stay the course, have a diversified mix inside of your portfolio, pay attention to, the location of those assets from a tax perspective, and then stick to the plan and manage our overall individual investor biases. I mean, we all have them, and it's important if you can't manage them on your own, to simply work with an advisor who's qualified to do so. So, Jeff, greatly appreciate the insight. Hey, before I let you go, I'm going to ask you the same question we ask every guest, and that is, what is the worst financial decision you've ever made? And I know that, being in the role that you're in, you've probably made zero, but having said that, there's got to be at least one.
I thought I would be able to get away without having that question thrown my way, Brian, but that's okay, man.
Nobody can dodge it.
So, it is important to review mistakes that you make. We try and do that in the portfolios that we look at because we obviously have successes and we have disappointments, and try and learn from those mistakes. And one of the books that I love is Big Mistakes of the Greatest Investors by Michael Batnick. A wonderful book, and I think we all could probably learn from that. I personally, you asked me about probably the biggest regret, the biggest mistake I've made financially. It goes back to the housing market, the housing boom. And I did buy a home at the absolute peak in the market. And I think we're probably, now 10 years later, just about back to cost in this market. Now, the good news was I sold a home where I made, a nice little fortune from my standpoint to finance that purchase. But certainly, it was painful. So did not have the ultimate prescience in seeing housing and just the depth of weakness on that front.
Well, Jeff, if it makes you feel any better, I can assure you that you were not alone in that crisis, and potentially, when you bought in. So you have that to look forward to. At the same time, of course, house is going to be very different than an equity that you buy, right? I mean, just from the utility perspective, and hopefully you've been able to create great memories in that house with you and your family. So I appreciate you sharing that. It's humbling for everybody, but we all make them. So guys, that wraps up another show. Jeff, again, thank you very much for your expertise and insight. So everyone, thanks for listening to the show today. If you have questions, ideas, comments for the show, please go ahead and email them in at podcast@marinerwealthadvisors.com. Thanks again for listening.
Mariner LLC, doing business as Mariner Wealth Advisors, or MWA, is an SEC registered investment advisor. Registration of an investment advisor does not imply a certain level of skill or training. MWA is in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which a notice has been filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money.